Welcome back to Strongman Personal Finance. Are you piling into big tech? Are you a genius investor who pulls up the 10-year chart and you use that 10-year chart to make investment decisions? Do you have an IQ that is hovering around 90? Well, if that's the case, I offer you the ETF known as QQQ. You can get exposure to some of the best performing large U.S. tech companies that will vertical line forever into the future, because nothing is more indicative of future performance than past performance. What happened in the past is all that matters, right? I fervently disagree with that. When you invest in something, you are investing in something now for the future. I don't care if something went up 20 billion% over the last decade. You are not buying that based on the past performance, because the future can bring entirely different, unpredictable, unknowable things. And I think a lot of you are really discounting the possibility that the stocks that everyone is piling into could potentially not perform as well into the future. I will also caveat that they could potentially continue to outperform into the future. Apple, Meta, Amazon, Microsoft, these are the kings. Nvidia, these things rule the world, and everybody is talking about it. Go look on Twitter. Go look at everybody's portfolio. What are the top holdings that you see in there? All those names I just listed. And those are the top names in the VT ETF as well. But those are weighted according to the global market cap, okay? A lot of you are massively overweighting these big names. The reason you're doing that is because of this. I don't want to hear any other excuses. I don't want to hear about American exceptionalism. I don't want to hear about patriotism. I don't want to hear about they're the best, bro. You are piling into big tech because you are looking at the past performance. Now, I'll throw some of you a bone here, okay? I'm sure some of you bought big tech for reasons other than it went up a lot. And I respect that. I got nothing against that. If you truly invested in these companies, simply because you believe there's something special about them that the market is discounting, I got no beef with you. What I do have beef with is the vast majority, I would say 90 to 95% of investors who literally pull up the 10-year chart and they base all of their investment decisions on there. And it sucks. It sucks so bad to be in the public eye and be the guy that's buying VT. Because if you pull up the 10-year chart or even longer, obviously there are other asset classes, there are other countries that have absolutely crushed the global market cap weighted stock portfolio. And this will always be the case forever into the future. But I warn you, there is a possibility that this trend will not continue. And if you are buying here, QQQ right here, or VTI or VU right here, there is a possibility that you are setting yourself up for lower expected returns. You need to accept that anything is possible in the future. You cannot claim that the past returns of these ETFs are yours, because they are not. If you buy QQQ in 2024, the returns from 2013, which is barely showing on here, all the way to 2024 are not your returns. You did not get those returns. Somebody that bought QQQ back then got those returns if they're holding on to it today. Do we understand that? Okay, let's continue and look at this interesting little thing. Now, forecasts, I tend to ignore them. I tend to just say, hey, at the end of the day, they're just predictions about the future. And I'm agnostic. I have a global market cap weighted portfolio. I have it now. I'll have it in 10 years, 20 years, 30 years, 40 years, until the day I die. I will be invested with the vast majority of my money in the global market cap weighted portfolio, which is best represented by the Vanguard Total World Stock Market Index ETF. I'm hazarding a guess that a lot of you are invested in the companies and the ETFs that went up a lot. And I want to warn you, you are facing massive potential risk. And if these risks materialize, the risk of underperformance, you will not be happy. You will not be rolling in dough and growing your wealth at 20% compounded every year like you think you're going to do. Okay, so let's go ahead and check out this Vanguard Capital Markets model forecast. So they have this little model where they kind of, I guess they just use current valuations, and I guess they have a bunch of inputs that go into the model, and it spits out expected future returns. Now, obviously, these things can be totally wrong, but there's also a chance it could be totally right. And if this turns out to be accurate, some of you are going to get blown out over the next, your little bussies are going to get blown out like they've never been blown out before. So let's go ahead and check out the graphic for what Vanguard projects annualized 10-year returns to be for certain asset classes. And they have 30 years here. I mean, we'll look at that, but honestly, that's kind of ridiculous. I mean, even 10 years is stretching it. But what are they forecasting for the returns for U.S. equities to be? Well, that's the top row right here, and I'll actually zoom in a little bit. So we have the annualized percentage return on the top here, so you can clearly see what's going to happen. U.S. equities, they are projecting, based on the model, 3.3% to 5.3% annualized over the next 10 years. Something could come out of left field and entirely change that. They could do worse than that. They could do better than that. But let me tell you, if they do this, you're not going to be happy. But it gets even worse. Let's go down a little bit. U.S. value my ALU. Okay, when you think about value, you think about low PE and, dividends and, strong, steady companies, right? So U.S. value, they're projecting to be between 4.1% to 6.1%. Those are solid returns. I don't know if these are nominal or real, but those are like decent. I mean, you'll beat inflation, right? Look what they're projecting U.S. growth to be. Actually, I think these are nominal. They're projecting U.S. growth to be between 0.4% and 2.4%. A lot of you, if this comes true, you will look like the biggest clowns in the mother effing world. I'm sorry to say that. If this comes true, and it's possible, U.S. stocks have been on an insane run. But when we talk about U.S. stocks, what we're really talking about is mega cap tech. Mega cap tech has basically provided a huge percentage of the total returns of U.S. stocks over the last, 10, 15 years. It's all been down to big tech. If those trends continue, that's wonderful. If they don't, you are going to be utterly obliterated. The reason people buy VTI and VOO is they think they're, diversifying. They're buying more stocks in the US, which has been the best market over the past 10 years. And, they don't want to be super concentrated in, just QQQ. And that's fine, but you can't just sit here and say, oh, well, it's okay to, only buy the U.S. market. That's fine. You don't need anything else, okay? Because that sentiment is literally based off past performance. Prove me wrong. Or maybe it's like, it's almost like a religion, like the, people have this like belief that there's something special about the soil of the United States. When really, I think a lot of U.S. dominance was World War II, entire world was destroyed. Half the world fell under communism. Then the communists fell in the early 1990s. And then we were basically the sole superpower for like a good 30 years, okay? But there are other countries that are developing and growing their GDP faster. And while there's not a correlation between GDP and stock market returns, maybe in the long run that'll change. I don't know. I mean, maybe U.S. stocks will continue to run forever. But if you say, oh, it's okay to just buy U.S. stocks, you're going to potentially get these returns, entirely possible, or lower. And they're projecting global equities ex-US to be between 6.7 to 8.7%. How much of a clown are you going to feel like if this happens? This is possible. This can happen because you are investing now. How are you going to compare 6.7% to 8.7% annualized returns over the next 10 years when you're, I guarantee you, probably just piling into mega cap growth. Okay? That's my suspicion about a lot of you, but you know what? You all are geniuses. So you look at these, and they're projecting developed markets, like Japan, Europe, to also perform very well. And you can come up with whatever excuses you want to say these are totally BS. Fine. But you have to acknowledge this is possible. How do you hedge your bets? Well, I have an idea, but you can figure that out yourself. But if this happens, I will laugh at all of you. I honestly hope this happens. I want this to happen because I am so tired of people just pulling up a 10-year chart, which 10 years is not a long time in a lifetime. It's really, it kind of is. But the fact that you just pull up these 10-year returns and you say, oh, this ETF's good, but this one's better, and this one's the best. Do you really think it's that easy? I personally don't. Okay, if it was that easy, then you know what? I will resign from my YouTube channel. If you just buy stuff that goes up a lot, so be it. Okay? But keep this in mind. There is a chance that, here it is. This is expected U.S. inflation over the next 10 years, 2 to 3%. So there is a chance that U.S. growth could potentially underperform inflation. And I know it's hard to believe. I know it is. But I guarantee you, if U.S. growth does start to suck, a lot of you are going to flee at the first sign of trouble. I guarantee it. Me? I don't care. I got U.S. equities. I got global equities ex-U.S. unhedged. I'll probably get roughly 6-7% returns, hopefully, and I'll be perfectly happy with that. But a lot of you piled into U.S. growth. If this comes to fruition, you're going to get your butts blown out, okay? U.S. growth looks like it's going to be the worst performing potentially over the next 10 years. Could be wrong. But if it happens, oh boy, you setting yourself up for a reckoning, okay? Now, we can humor this a little bit and do 30-year returns. This is like even more ridiculous. So, funny enough, if you bought U.S. growth, they're projecting, if you buy it now, they're projecting that U.S. growth stocks will return between 3.3% to 5.3%, which will slightly beat inflation. But by that point, you'll have already sold out of U.S. growth, okay? So I just want to reiterate, you got to resist the call of the past performance. It is addicting. It's like crack to look at QQQ. Even U.S. stocks and VU versus VT, it's so hard to resist because you have that fear inside of you that you're missing out on so much wealth, which, funny enough, I think is the reason that bubbles happen. Or not even bubbles, but potential overvaluation happens or euphoria happens is because everybody, they look and they see QQQ's returns and they see VTI's returns or VOO's returns, which, funny enough, people like VU because it went up a little bit more than VTI. Guarantee it. They look at that and they say, I can't miss that. And then you look at VT and it's like, that's a joke. That's a joke. Why would you buy? It makes no sense whatsoever. But it's not about what happened in the past. If you internalize this lesson, I think you will become a much better investor. And if you buy something like VT, you don't have to worry about this. You don't have to worry about this at all. I hope that returns over the next 30 years are roughly 7% on average, okay? That would be beautiful. I would be a multimillionaire. But if you're making the mistake of piling into something that went up the most and has massively outperformed that everybody else can see, you got to be prepared for the possibility that that could happen. If you don't like what I'm saying, that's fine. It's perfectly fine. But don't, for the love of God, brag about past performance because it's a grift. It really is a grift where you're flexing your investment prowess by buying something now and then claiming the returns of the past. Okay? So I'm going to stick with my VT. I know it's just so bad. This can't possibly ever change. It's literally impossible. America is number one. Our stocks will go up at 10, 15, 20% compounded every year forever into infinity. And there's no possible way that we could potentially be in some kind of, I don't know, bubble. I don't want to call it a bubble. but a period of increased euphoria with U.S. stocks, because I see it everywhere. Everybody, VUG, VTI, QQQ, automatic answers, pull up the 10-year chart. And to me, that's concerning. That concerns me. I can still win in my long-term investment success by buying VT, dollar cost averaging into it, reinvesting the dividends in a tax advantage account. But I think a lot of you risk have the real possibility of losing a lot. This is possible. Keep that in mind. Have a wonderful night. Cheers.